All right, if you're watching the video tonight, you might be one of the very few people that's paying attention to the markets today. As you'll see, there weren't a lot of participation in the markets, but it might be a little bit broader of a rally and a little bit more risk on than you think. So I'm going to show you why I say that. I'm also going to show you a stock that's getting hit a little hard by these headline risks. It might be hit hard also by any potential increase in volatility. So let's go ahead and get started. Today is Monday, August 6, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for tuning in tonight, especially those that are watching us for the first time. Glad you found us. Keep coming back for more. Subscribe to our YouTube channel by clicking the Market Scholars logo here in the bottom right corner of the video, or mouse over that logo. Click the red subscribe button that pops out. Also, down below the video, click the thumbs up icon. That lets me know two things. You like the video tonight, you want me to keep doing it. Really easy one-click way to give us feedback. You can do that right now while you're watching. Comment on anything that stands out to you from today's video. Join our daily Market Outlook email list by clicking that logo, or that link, that's popping out in the top right corner of your screen. Follow me on Twitter for more content like this, and join our Market Outlook community on Facebook. All right, let's start off taking a look at the S&P 500 with the market forecast indicator here. You can see we continue to have a strong bullish posture with now the market sentiment line getting close to crossing above that 80th percentile. So it is almost there. The near-term line entrenched in the upper reversal zone. So positive bullish sign. We talked about that Friday, this overbought cluster. Getting that cluster was a good sign going forward in terms of how bullish we are. We expect 1 to 3 months, typically from the time the green line crosses above 50. We are almost about 1 month. So this was, the 9th, and we are on the 6th. So now the day before the 9th was the 6th. So we're close to a full month of an intermediate run here. Obviously, we're up to a much higher high than the last intermediate high point. And you can see we're also above that high point over there. We still haven't got to new all-time highs in the S&P 500. So there's still a run to get to, probably by the end of this week. Because remember, by the end of this week, seasonality will turn bearish for the S&P 500. More bearish than it's been, and bullish for volatility. So we'll keep our eyes peeled for that. But absent seasonality, just looking at the indicator itself, strong bullish posture that's supported by rising market sentiment and a overbought near-term line, which is not bad when it's overbought for only a couple of days. See, the near-term line has been above 50 now for let's see here, what would that be? 1, 2, 3 days, and that's the blue line. And so we're looking for 7 to 12 days potentially of having the near-term line in the upper half of the chart. So, coming off of a bearish posture, it's not surprising that we'd get at least a 10-day near-term run that we're 3 days into right now. We'll take a look at the Dow Jones Industrial Average here. You can see it's not quite up to new highs yet, and it's a lot further off of its all-time high. It had such a good run at the end of the year and the beginning in January here. But we still do have a bullish posture. Market sentiment's rising. It's the one that's lagging the most. It's still rising up there. And you can see now the near-term line is in the reversal zone, just like the S&P 500. So a good setup there from the Dow. Looking at the NASDAQ, its near-term line is also entrenched in the reversal zone, so a positive sign for the tech-heavy index. Its bullish posture is renewed. Not quite above 80th percentile what market sentiment is. And you can see it's really close, a lot closer to its all-time highs than the S&P and the Dow. And then finally, you look at the Russell 2000. It's had a bigger pullback. It's had a bigger consolidation, whether it's a pullback or not. It's had a bigger consolidation here. It's lasted for a lot longer, and you can see not as bullish in the short term either. Its near-term line actually dropped today and pulled back without getting really significantly into the upper reversal zone. And you remember, it's coming off of a bigger short-term low point than any of the other indexes had. So the Russell's been a lot weaker. That doesn't mean that, if you can see over here, you still had a better day. There's your Russell 2000, there's your mid caps, and then of course there's your S&P 500. So broad rally today when you consider all the stocks that were involved in it. But it's got to have more days like this for that strength to get renewed. It's the one that's lagging behind, and when the Russell lags behind, that doesn't necessarily mean that we're going to immediately turn around and head lower on the broad market, but it's a sign of a maturing bullish market when large caps start to outpace small caps. Now, it's been outpacing during a consolidation for small caps, so we'll see if this little ascending triangle, cup and handle, whatever you want to call this pattern, if we break through the new highs here, that's going to be bullish. You're looking at, if you were to measure the distance here between 1708 down to about 1640, you're looking at about a 68-point move above 1708. You're looking up to 1776. So that would be kind of up where my cursor is here. And that would be a pretty decent move based on the price pattern. So it's going to be some pressure on it until you get to that significant resistance. Breaking through that resistance with a decent range will help solidify a pretty good bullish move and keep the market posture bullish for going forward. Because remember, market sentiment for the S&P 500 just barely crossed above 50 at the beginning of June. We're only 2 months into this orange line crossing above 50. And that's typically about a 6 to 9 month run. So we still got some time. Doesn't mean that we're going to be up every day and every week, obviously. But we've got multiple intermediate rallies that, of course, we're just right now in the second one. We're expecting, based on that market sentiment move, 3 or 4 intermediate rallies. So at least 1 or 2 more after this one ends, whenever it ends. All right, a quick reminder that you can watch our Market Outlook video on MarketScholars.com. And we ask if you want us to keep doing these videos, let us know with these 3 clicks. You can do it right now while you're watching. One is to click on tonight's Market Outlook tweet. If you have a Twitter account, go ahead and click like right there. We'll bring up a new window and you can like it. Also, you can click on this icon. That will take you to your Facebook account. You can like it there and share it with your friends as well. And then finally, the third click would be right there. So through those 3 clicks, tell us, hey, David, we liked the video today. We want you to do it again. Keep on doing it. And also remember, too, you can see our classes that are coming up over here. And you can subscribe to our site for free by clicking on this link, which will allow you to participate in our Market Outlook forums. All right, you can see the long-term chart for the S&P 500 continues to point upward, and you can see the gap between the 15 to 200-day moving average still rising. So at some point in time, obviously, it's going to get too much. And even right now at 94.8 points, that's higher, than most of these areas here. You can see the rest of them are gradually moving lower. It's not as high as we were earlier this year. So in that, we kind of looked for this progressive lower highs, and we were starting to get that, absent this crazy peak that we had in January. And then you can see now we're almost back up above that high that we had in March. I don't think we'll get very much higher than that. We'll see, but not according to the trend. So we'll see how much longer the long-term momentum continues to rise. But being above a rising 50-day moving average and a rising 200-day moving average with the gap between the two getting bigger is about as bullish as you can get on the long-term chart. And then finally, in the 3 green arrows, you can see we're back to having 3 green arrows now. And the MACD turned up today. So we have all 3. We're shaded green there. We have all 3 lines green. You can see, too, when you look at when you put the lines, break out the lines, we're above the 8-day moving average. In fact, kind of a new high in the S&P 500, getting above last week's high. MACD and stochastics both crossing above their moving averages. How high they go, we'll see how much of a divergence we end up getting, because obviously you can see, this would have to get up into the mid-90s to nullify any potential divergence there, and then the MACD would have to get up above this, 20 level, which it's done before, but it have to get up to about 20 or higher to nullify any potential divergence there, since we are already just slightly higher highs on the index itself. All right, when you take a look at the intraday chart, you can see just how bullish this move has been since Thursday's open. We opened up near 279, opened up near some important kind of near intraday support, and then as pushed up, and we got a new 4-week high point today. and we're trading a lot closer to the 4-week high than we are in the midpoint. So, and we talked about the idea that at least over the next few days, eventually this line here at the bottom is going to move up to right there. So it's about another almost 2 points higher, which will put this up to almost 2 points higher. So probably up to 282.5, maybe up in this range. So that's where the midpoint will be here in just a couple of days. Once we get through that low point, it's going to move up to there. So probably by Thursday, Friday, we'll have it here for a couple of days. So that kind of shows you that, yes, we're pretty bullish now with a wide range, almost 10 points, but that range is going to close pretty quickly. And after that comes off, you'll be kind of in this area, and that 280 area, again, almost 3 points higher would put us up to 283 and a half, and that's 283 and a half in that area. So again, that just kind of shows, it'll probably be more like in this 282 area. You'll probably be right in there. That just kind of shows just how, things can tighten up really quickly if we don't keep pushing up to new highs, which I actually do expect that will continue as this rises up. We'll continue to push this up, at least this week, before potentially seasonality kicks in next week. If you take a look at today's range, coming in below the average at 2.19 points to 1.79, look at today's volume, how abysmally low that is, 39 million. Just for some context here, 39 million puts us way down here, well below the average, and well below the 52-week range for that average. And 1.79 points on the ATR is still below the average, which is still bullish. And we're in the bullish range with the average or relative ATR being below that key 1% level. If you look at the volatility index on an absolute basis first, remember Friday we were pretty darn low, and today you can see, starting up a little bit higher and then pulling down to even lower low. So, 11's pretty darn low for the VIX on an absolute basis. We haven't been this low all year long since the very, very beginning of the year after we had that spike at the end of January. Remember how low that volatility was and what it prompted. Now we had a 5-month intermediate run, which is way longer than normal. We are only now, we're not even 1 month into this one. So it's not too extreme. And you can see when this 5-month rally started, volatility also got down to about 11 in this area. So just because we're down here doesn't mean it has to go up. But if you look at it on a relative basis here, it is now below 80%. So it is, extremely low. That's a big low point for volatility. This is the bullish range, the normal bullish range, and we're now in the abnormal bullish range. And typically, it will bounce back. Even if it just bounces back up to this 85 level, at least that would be a short-term move higher in volatility that would produce that kind of a move. Now, again, just a reminder, back when we had this run started, this 5-month intermediate run started that ended with that big drop. So this really abnormally long intermediate run, it also dropped below 80% and stayed there for a while. So again, because we're getting down here doesn't mean it has to bounce back up. It is an extreme low, so it's not like we want to be prepared for this kind of a move, because it can happen at any time, and it happens mostly when we're extremely low like this. But it can stay down here for a while, and like I said, I think the rest of this week we can expect it to, but then heading into a normally seasonally time for higher volatility, you can see this is the mid-August to late August. You can see how it jumped up into this middle, to this neutral range, and up above that. That can come seasonally. It typically comes this time of year, so we'll definitely want to keep our eyes peeled for that type of move coming from these extreme lows. It would prompt a bearish move on stocks that at least would be a short-term pullback. And now that we're a month into this intermediate run, there's the growing possibility of an intermediate term pullback too. But again, that's okay because we're expecting multiple intermediate runs. You can't have multiple intermediate runs without the intermediate run, one intermediate run ending with an intermediate pullback, and then to a new higher intermediate low point on the S&P, and then it bounced up higher. We're already up to a higher high, so it would not be a bad thing to get a pullback to a higher low point and then a renewed bounce for the third intermediate run on this current long-term trend that we're got the expectations for that 6 to 9 month run. So there's a link popping out in the bottom top right corner of your screen. Click on that link. It opens up a poll. Click on agree or disagree. Do you agree with this market posture and that the trend is still strongly bullish and we expect that bullishness to continue this near-term run at least through this week, with an eye looking forward to higher volatility, especially from these extreme lows in volatility that we're getting down to. So we're going to keep our eyes peeled for that. But we're not expecting any significant pullbacks other than the normal ups and downs and ending this second run and looking for the beginnings of a third run. That can happen as early, at least that can start to happen as early as next week. And even then, that might just be a near-term pullback. And we might continue this intermediate run that we're on now for another month or two and still be considered perfectly normal. So until things change, considering how bullish the charts are, that's the kind of move that we would expect to see. Do you agree with that? Do you disagree? Let us know there in the poll with one click. And if you disagree, scroll down to the bottom and comment. Comment on what you're seeing. That would suggest that maybe we are more bearish, or we should expect to be a lot more bearish than maybe anticipating just a near-term or even just an intermediate-term pullback. All right, now if we take a look at what's driving this price action, this bullishness, and again, it's a kind of a pro-USA response. I mean, there wasn't any significant news out today other than, tariff reaction, right? Tariffs from the other side, from China being released and how that might be impacting the markets. And so far has not been that bearish. In fact, U.S. markets continue to outperform on a broad level. Again, as I mentioned before, small caps, mid caps, both outperforming the S&P 500, growth stocks outperforming value stocks, and even the dollar, all the bond markets are up today, a little bit, not very much. The dollar was up. Where is the dollar? Right there. The dollar was up today, so that had the typical impact on these international areas, as well as gold prices continuing to come down. And really stocks across the board, small caps and mid caps, but you also had dividend stocks, preferred stocks were up a little bit, MLPs were up with the rise in crude oil. You can see crude oil down here at the bottom, coming up potentially off of a low point. It's a red moving average there, along with all these other asset classes that are impacted negatively by the dollar. So, and you can see the dollar is trying to make its way up, break out to a new high. And as long as the dollar continues to move higher and stocks continue to move higher, then we can see this result where it's a broad move and U.S. assets outperform. There will come a day where that won't be the case. And the dollar will break down. So it's a strong move that we've had on the dollar. But as of right now, the trend continues to show to the upside, and mainly because of a pro-U.S. response so far to all these headlines that are out there regarding tariffs, regarding anything that's been any headlines that have been coming out from Washington from the administration. It's been at times temporary setbacks because kind of knee-jerk sell-offs, but those sell-offs last, sometimes not even by the time the market opens before things are starting to rally off of low points. So as we're currently seeing right now, so the trend is still higher for a lot of these asset classes, as long as the U.S. dollar continues to push higher. And if the U.S. dollar starts to drop, but stocks continue higher, then look for value to start to outpace the growth, and look for the S&P 500 to start to outpace these other areas, and look for a sector rotation as well from technology and discretionary into dollar-sensitive areas like materials and energy. Really quickly, before we look at the sector rotation, I did want to look at these foreign markets, and you can see the S&P 500 continues to be the biggest gainer, and you can also see too that the stock markets, the Canadian stock market continues to be above a rising moving average and show this overbought cluster, and same thing with Brazil. That's one emerging market area. But you can see really there aren't very many markets, Brazil and India being the two emerging markets that are doing well. But U.S. and Canada, everything else is still showing weakness all across the board, in Europe as well as in these emerging Asian markets, particularly China, obviously, and as well as Korea. And then finally, if I were to take a look at the currencies and how they're doing, let's take a look at the currency chart here. Right there. You can see it was a broad bullish day for the dollar. Everything down, all the major currencies down against the dollar, and all the trends continue to be down against the dollar. Remember, these up here are the base currencies, and down here at the bottom, the dollar is the base currency. The dollar is only falling right now against the Canadian dollar and the Mexican peso. It continues to rise pretty strongly against a lot of these other major currencies out there. So again, that's had its impact. It's had its impact on what asset classes are doing well, which ones aren't. Crude oil has been able to overcome that, but gold hasn't. These emerging markets and EFA are still lagging behind, except for a few markets here and there. That's all because of the strength in the dollar. So now we take a look at the sectors, and we'll see that they're also showing this, similar. Let's get back to the watch list here. They're also showing similar response to a strong dollar. Let's switch this gadget and go back to a watch list, and we'll look at the sector rotation. Now, here's the S&P 500. So today you had your typical bullish leadership when the dollar's rising. That's technology and discretionary. Financials doing well, even with a little bit of a jump higher in yields, or in bond prices, a little bit of a drop in yields. But remember the yields, and that's something I tweeted out today. The yields are on a strong trend and may be making a run up to levels that we haven't seen in a while. And so that will impact the financial sector, especially if the yield curve were to avoid completely flattening. If those long-term yields continue to make a good, decent run ahead of the pace that the Fed raises interest rates, right? And you can see lagging the market. You can see healthcare has been a strong sector recently. Still up today, but lagging about half, coming in half. And then industrials and materials impacted the most by the tariffs. And you can see these other safe haven areas lagging a little bit behind the markets, up small gains today. But this is a typical risk-on bullish day because that's the type of market that we're currently in right now. All right, one stock that's kind of getting caught up in the Chinese weakness here lately is Alibaba, breaking down below a previous low point here with some pretty decent volume today. Not a big move to the downside, but this past week plus has been a pretty sharp move with 3 red arrows down to a new lower low point as of right now, at least. And so, and again, if there's any weakness in the broad market, especially if technology starts to pull back, which is that market leadership there, then that would also kind of hurt this particular area. So there's an opportunity. We've been doing a lot of bullish trades lately. There's an opportunity to do a bearish trade on this stock. And again, the market's strongly bullish. We don't want to be aggressively bearish, but we can look to sell that mid-30s delta, selling the 190, buying the 195. You can see when you analyze that, and put your break even. You're trying to make $125 for $375 of risk. Your $125 loss would be kind of in that 192 area. So that puts you up, up above that low point that we're breaking down below now, and up into this spot here where that blue line is. And anywhere above that now, you lose more than what you're trying to make, more than a 1-to-1. So we have a pretty decent probability as well, up in the 70s, with a decent credit. You might have to finagle that credit a little bit. There's a little bit of a wide spread. So somewhere in there is probably what you'll end up getting. And remember, $1.16 gives you that 30% return on risk, which makes it easier for you to manage to a 1-to-1 profit-loss ratio on this vertical spread. So So it's an opportunity to take advantage of weakness in that particular market with the headline risk, as well as any potential weakness in the sector if there is any increase in volatility earlier than expected or next week as expected, or if that volatility turns into something more than just a short-term pullback, you'd expect that it would impact this sector. And again, you've got some pretty strong support down here, but it doesn't have to go down. It just has to stay down below that area. So we can get to that support and muck around for a while as long as it doesn't bounce up sharply. And if it does, we'll take our small loss and move on to another trade. All right, so that wraps us up for today. Thank you very much for watching tonight. I appreciate you coming on, and especially those that are watching for the first time. Come back, watch again. Let me know what you think about today's market outlook video. There's a link popping out in the top right corner of your screen, or has already popped out. Click on that little I if it has, and that will take you to our forums, among other links that are up there. And let me hear from you now. What do you think about this market posture? What do you think about this trade idea tonight? Let me know your thoughts. Whatever questions you have for me, you can post in the Market Outlook forums too. There's a really knowledgeable market scholars community that will also be able to you can be able to interact with that watches these videos day in and day out. So make sure you subscribe to our site and participate in the forums in our community. Thanks again for watching. Remember to subscribe to our YouTube channel. Click the thumbs up icon down below and comment. Also follow on Twitter for more content like this, and then join our Market Outlook community on Facebook. Again, thanks. Have a great evening, everybody, and we'll see you all next time.